Hi, I am Kiryll Prakapenka, an associate here at Frontier Advisors, and today I have the privilege of discussing Frontier's latest edition of the annual Secular Outlook with its lead author. How convenient. Senior consultant Alexandra Veroude. Alexandra, welcome. Thank you for joining me.
Hi, Kiryll.
Now, we've got a lot to cover from AI, obviously, to Trump unsettling the global order and to inequality and shift in demographics. But before we do any of that, I just wanted to ask, why does Frontier publish the ASO? What use does it serve? Why is it important?
Great first question, Kiryll. So the annual Secular Outlook, or the ASO, which is much easier to say,
Hmm.
this has been produced for a number of years now. It's a report where we take a big picture perspective that we advocate investors need to consider as long-term drivers of economic and financial market outcomes. As you said, this year, AI, artificial intelligence, is a big feature. We focused on this a couple of years ago, but we felt like the ASO really warranted a renewed deep dive, given the pace of technological innovation that we're seeing, this surge of investment spending. I mean, AI has really been a talking point over the past year. And we also explore how AI interacts with our other key secular themes. A few of these you touched on, but they're climate and energy security, global order, debt and demographics, and inequality.
Great. Well, let's talk about AI. Everyone else is, but for good reason. So, where is AI heading, and how transformative is it going to be? And is it actually going to be as transformative as people think?
Very big questions that you're asking there, but let's just start with where we are now. So, we're currently in a phase of elevated investment. We're seeing large amounts of capital being directed towards AI related projects. This has really been fueled by fear of missing out mentalities and expectations of winner takes all outcomes. As we've seen with periods of previous technological transformation, not every venture will succeed. We're seeing that firms are at different stages of development and adoption. We're seeing this from all the way at the early stages of R&D, all the way through to AI being implemented across a business and improving performance. But it is expected that in aggregate, we'll see AI improve overall productivity. This means that being able to produce more goods and services with fewer inputs of labor and capital. We've seen in the past that periods of productivity uplift typically translate to improved living standards, greater wealth per capita, but they feel that gains are likely to be uneven, really shaped by decisions of individuals, businesses, and governments.
Yeah, and maybe can you speak more about the uneven gains and especially the risks? Obviously, AI is such a big popular topic. A lot of people understand the potential benefits, automation, augmentation, but what are the risks other than, robots taking over?
That's correct. There is so much unknown about the future that role that AI will play in our lives. While the upside has the potential to be huge, the risks are not insignificant either. The risks range from privacy, data security concerns, model bias, hallucinations, safety and reliability, which is particularly important in sectors such as healthcare, passenger transport, and then to more serious concerns around ethical and societal consequences from these technologies. AI will be used in surveillance and military applications. What if these AI technologies become misaligned with human values? And it can be that regulation can either act to slow adoption, or perhaps it's unable to keep up with the pace of
Hmm.
technological development, leading to everyone's worst fear, as you mentioned before, the robots taking over.
Well, if it means there's no jobs to do, maybe robots taking over isn't such a bad thing after all. But we can't talk about AI without mentioning the Magnificent Seven and the market concentration in equities, especially with firms like Meta, Google, Amazon, etc. So uh, could you maybe touch on that and especially how it relates to investor risks and how investors should consider these issues?
That's true. As you said, it's been a very well documented story that tech stocks have rapidly increased their share of MSCI World Index over the past few years. In fact, we actually saw that the Reserve Bank of Australia, in their most recent financial stability review, noted that this concentration of tech related stocks in equity markets, this is a potentially a key risk to financial stability. And this is also as we're seeing that exposures are growing in private equity, private credit. Mag 7 names are increasingly tapping public bond markets to supplement funds raised elsewhere. And then if we take a step back and we look at real assets, data centers are becoming a real hot commodity. They're supporting the enormous computing power that's required to train and run these AI models. However, this should really be considered a higher risk asset. There's so much uncertainty surrounding the future capacity needs, and it's likely that continual expensive upgrades will be required to avoid these technologies becoming obsolete.
Because it's technically, in a weird, ironic way, data centers could become stranded assets because if AI improves efficiencies and there's less demand for power with those efficiencies, then there will be an oversupply of data centers, and that's a big risk because I think data centers, like you said, are a very hard investment right now. But I guess that's why we have the ASO to consider both sides of the issue and consider the benefits and the risks.
That's exactly right, Kiryll. I think with where we are at the moment, there's certainly a range of scenarios that can play out. So for asset owners, for investors, they should really be looking at their portfolios and the exposures that they have for a range of different scenarios that we see as possible.
Yeah, and you mentioned different sectors that are involved in AI. And speaking of these sectors, the ASO actually contains a new table that wasn't featured before. And it's done some quantitative analysis by your team. It's very great work, very well received when you presented it this week in the team meeting. And basically, the table assesses the disruption risk of the different gig sectors and industry groups. Now, are you able to share some of the insights on here, or does it remain a trade secret that someone just has to get the report to access?
Thank you, Kiryll, for that very kind praise. That's right. The report does contain a table of quantitative analysis that we undertook, and we were able to use this to distinguish sectors that we see as ripe for disruption from both a labour and a capital point of view, potentially seeing large upsides as AI technologies are implemented throughout these businesses. But you were right in saying that there might be some trade secrets there, and that's actually all I'm going to say on this for today. I'm going to leave this as a little teaser to entice the listeners to access and read the ASO publication in full, where all the details of that analysis are contained.
Very good, fair enough. So consider it a teaser trail, and we'll leave it as a cliffhanger and move on to another topic in the ASO, which is climate change and energy security. Energy security is a new term in the ASO, and it's been paired with climate change to create this wider topic. So maybe the question is, why did you introduce energy security, and why did you pair it up with climate change?
So we took the decision to broaden the concept of looking at the environment energy from purely a climate change perspective to rebranding this as energy security, which we see as a broad term that encompasses the delivery of cheap, reliable, abundant energy and not solely reliant on a single source or supplier. And this is because this has really emerged as a strategic national priority under the Trump administration. We've seen that they've shifted their focus away from clean energy investments towards energy expansion. And this is really to support the large AI investment. As we mentioned before, data centers, these are extremely energy intensive. The IEA, the International Energy Agency, expects that data centers will drive a huge uplift of energy consumption. And this is really going to be concentrated in areas where these data centers exist. The US, it recognizes that affordable, abundant energy is a critical input for AI dominance. And as I mentioned before, in some of the risks where we see AI influencing military surveillance capabilities, this has been a key motivation behind the US.
Now, does all of this imply that climate goals are maybe potentially sidelined? Now, is it now the case that it's energy security or climate action, or is it the case that it can be both climate action and energy security?
I like to think that phrase it as complicating efforts towards net zero. Um, but yes, it is widely agreed that the planet will overshoot its 1.5 degree goal. Global emissions are still rising and energy demand is set to surge. However, I think there could be some scope for optimism. We're seeing breakthroughs. It could be that breakthroughs in processing efficiency could mean that this anticipated surge in AI related energy consumption is not as large as it is expected to be. And we're already seeing AI playing a role in optimizing energy generation, optimizing grid management. This issue here is particularly important for general insurers as they're exposed to climate change risks, i.e., higher claims from catastrophic weather events. And some are leaning towards in investing into hedging these risks by allocating to assets such as data centers, renewable infrastructure, or indeed lower carbon equity portfolios. Given the potential for potential stress on both sides of an insurer's balance sheet, we believe that testing for a range of scenarios will help assess the risks and opportunities that come from this broader thematic of energy security with a more holistic approach.
Great. Well, I think with energy security, you can't talk about energy security without talking about geopolitics. And if you talk about geopolitics, you have to mention the global order. And global order is definitely one of the key themes in this year's ASO. Major powers are definitely trying to secure resources to support, for instance, investment in AI, but they're also definitely ramping up spending on defense. And the ASO this year explicitly talks about a defense super cycle. So what does this mean and how should investors approach this?
Thanks, Kiryll. That's correct. We broadened this year. The theme was previously deglobalization, but we broadened it and sort of transformed it into global order. We saw that the US, with its America First strategic agenda, is shifting supply chains, not only due to tariffs, but also to reduce reliance on any single nation. These activities ultimately add to inflation, fighting against theories of economic scale of economies of scale. But we're also seeing that because of all these geopolitical tensions, conflicts, challenges, this has driven the steepest increase in military spending in the past 30 years. And we're with the NATO's new 5% GDP defense spend benchmarks, this suggests that this militarization trend is set to persist. This surge, however, we think that this surge in military spending needs to be weighed against the already mountain of fiscal debt, which we see as potentially exacerbating political instability, undermining economic resilience.
Yep. Now, you've mentioned mountain of fiscal debt, so we might as well mention fiscal debt and talk about it. It definitely has its own topic in the ASO, and it also connects nicely to the issue of demographics, especially the aging population. So, how do these topics obviously interrelate, and how can AI aid or not aid this?
So we interlinked these topics this year, as you mentioned, and we took it from the angle of, well, aging populations. This is not a new thematic, but UN estimates actually expect that developed countries will see their working age populations shrink by 2030. So this means that fewer workers are available to support growing number of retirees, so assist with healthcare costs, pensions, and aging populations are widely viewed to slow GDP. If we then think about slowing GDP, means that governments need larger budget balances to stabilise debt to GDP ratios. However, governments have shown little appetite for this. We're seeing they're continuing to expand public spending and accumulate debt. Then if we also think about, well, we're seeing interest rates well above pre-pandemic levels, and this means that more and more government funds are being forced to repay interest expenses, taking away from essential services or forcing governments to borrow more just to maintain these level of services, thereby deepening the debt cycle. We see that AI, it could slow the economic effects of aging by enabling older workers to remain active in the labour force or assisting with aged care related duties. It could also be that productivity breakthroughs lessen the burden of demographics. However, when we think about that with the topic before, with these larger defence spending requirements, it really seems that larger fiscal deficits look set to remain. And again, this is particularly important for liability driven investors. If global government debt is expected to be nearly 100% of GDP by the end of this decade, coinciding with higher debt servicing costs, insurers who are natural holders of government bonds may need to be wary of the heightened risks of owning these bonds, which are currently at very low risk, capital efficient, and natural liability hedges.
What's interesting to me is that you mentioned that one of the risks of AI is, robots taking over, but maybe another another risk of AI, maybe personal, is that older people have to work longer, and the retirement age gets pushed even further with with productivity gains. So something to look forward to, I guess. Longer working life. Well, finally, the remaining topic in the ASO is inequality. Obviously, inequality is a pernicious issue, and we've seen in countries like the US that the inequality gap continues to widen. As with other topics, AI is definitely set to play a role here, but the key question is whether it's going to play a positive role or a negative role. So I'll ask the big question to you. What do you think?
Well, as a typical economist, I'm going to answer that with on one hand and on the
Yep.
other. But yes, there are risks that AI might amplify wealth inequality. Higher income households seem better positioned to invest and benefit from AI-related capital gains. We're seeing that there is some increase in unemployment at entry level jobs, which could be related to disruptions from AI, reducing the need for entry level workers. But further research needs to be done to attribute a true causal effect. In a more optimistic scenario, it could be that AI helps to reduce inequality by reducing barriers to education, provide access to learning resources that were previously unattainable. I do tend to be a glass half full person. I do think that AI will present new opportunities, new employment pathways, and I mean, the robots certainly wouldn't have been able to have an engaging conversation like this
Well,
at this
definitely
stage.
not yet at this stage, yes.
Mm.
And long may they continue. Well, before we go, I just wanted to ask you a question. Maybe can you please summarize all of the key themes that, like, for instance, a liability-driven investor might take away from here? Like, what should they consider, and how should they position their portfolios going ahead?
So, connecting all these issues, there are several themes in the ASO that suggest greater inflationary pressures may eventuate than what we have seen in the previous 20-year quite benign inflationary environment. This is especially relevant to long tail insurers. Insurers must consider how best to efficiently hedge those inflationary risks, apart from repricing risk and managing supply chains. Investing in securities such as inflation linked bonds are obvious to many. However, there are other asset classes that can access to hedge against unexpected inflation outcomes.
Well, this has been a very insightful discussion. I hope that this discussion could not be had between two robots just yet. Again, thank you for taking us through the ASO. It's been wonderful. Of course, if anyone wanted to get their hands on a copy, just please contact your friendly Frontier Advisors consultant. I'm sure they'll be able to send you a copy. But Alexandra, thank you once again.
Thanks, Kiryll.